Welcome back to my channel. Today's tutorial is about power of compounding. Benjamin Franklin once said, "Money makes money, and the money that money makes money." He was describing the concept of compounding interest, like a snowball rolling downhill, gathering size and speed with each rotation. Compounding interest is the phenomenon that can transform small investments into substantial wealth over time. When interest is made on interest, not just principal, the bigger the snowball gets, the faster it moves, continues to grow and gains momentum. A familiar example of compounding interest for many people is its negative impact on your debt, like unpaid credit card balances. When unpaid interest is added to the unpaid principal, you create a larger total for interest to compound. This is why it's so important to only spend what you make. Pay all interest on credit cards or loans and lower your outstanding balance. This gives you a double bonus, as interest does not get compounded and decreases over time. Plus, you have more available money to invest. Your goal is to get compounding interest to work in your favor when you invest, and the beauty of it lies in its accessibility. Anyone, regardless of income or background, can harness its power. It's one of the easiest ways to debunk the financial myth that you have to have a lot to create real wealth. With compounding interest, investing small amounts can add up over time, especially when you continue to invest incrementally. How to take advantage of compounding interest. The two ingredients to compound interest are time and consistency. Let's dive into each one. 1. Start early. Time is your greatest asset when it comes to compounding interest, and the earlier you start, the more time your money has to grow. That's why financial literacy and wellness are so important. The sooner you understand how much money you make, how you spend it, and what goals you need it for. Let's say you have $1,000 of available funds and decide to invest in a 401k or savings account that earns an average annual return of 7% with compounding interest and without adding anything to it. Over the course of 30 years, that initial investment would grow to approximately $7,612. Second is consistently add over time. Imagine that same $1,000 investment with an average annual return of 7%, but you commit to adding $500 to the pot every year. After 30 years, your investment would grow to approximately $43,800 over 5 times what it would have been with the additional contributions. Said differently, $16,000 invested with compounding interest results in a cumulative return of almost 175%. By consistently adding to your investment, you're increasing the principal amount that's compounding and taking advantage of the leverage from exponential growth potential over time. You're continually fueling the compounding process. In next video, I will explain you how to grow money and where to grow. Thanks for watching. See you in next video.
Subscribe our channel for more information about stock market trading and investing.